What's up, traders? Welcome back to another video talking about the markets. And specifically, we're going to talk about buying puts, which a lot of people love to do, especially as we get up to all-time highs. But is this a good idea? Now, some people may be thinking, I'm going to say, no, it's not a good idea because stocks only go up. And statistically speaking, they do. But there's actually nothing wrong with doing a strategy where you're buying puts consistently. Keyword there. And I'm going to talk about why consistently is so important. But in order to understand the proper way to do it and the correct way, you need to understand what drives options prices. Some people may not be looking at the VIX to gauge their option buying, but they really should. It's the best tool out there. And if you're not looking at it, you're trying to trade with one eye. So let's look real quick at some statistics and some data that I pulled up to illustrate this point that I want to make to you all. So what I went through and did was made a little spreadsheet right here of the SPY puts for the last year and well, for the last few months since beginning of 2021. And so you have the basic SPY price. This is going to be the closing price of that date. We take, let's just say, a nice standard 5 points down from that closing price. We rounded because we have to figure out a strike price to do it on. And then here's going to be the put price. That's what that put would cost at the close of this day. And I added this column here for the VIX, and this is the price of VIX at the close of that day. And as you see, the same distance, the same negative 5 point put on different days is going to have some very different pricing. For instance, on the 4th of January this year, the price to bet on the SPY going down 5 points was $2.41, $241 to buy that put. Meanwhile, if you go a month later to February the 8th, that same movement, 5 points, would have only cost 81 cents. Very drastic difference. Let's chart this compared to the VIX. So if we look here, and I've normalized this data to make it a little more clear, the VIX and the price of puts on the SPY are directly correlated. This is no accident. This is not some statistical thing. That's what the VIX is based on. The VIX is a measurement of the options pricing of very close dated options on the SPY. And so as the VIX rises, so do all the options prices, puts and calls. And so if the VIX is high, options are going to be highly priced. So it really behooves us as traders, if we're looking to buy options, to of course try to buy them cheaply. And so when the VIX is high or relatively high, it may not be the best idea to buy puts. Now, of course, now the VIX is at the lows for the year, so puts are actually pretty cheap. So it's not actually a bad idea to buy these options, but you're going to take a lot of losses as the bull market continues. And we are in a bull market despite what the news may say. Here is an example from last year of where this actually comes into play and how people can do this successfully. So this was from April 8th, a year ago. There was a fund called Universa Tail Fund that returned 3,600% in March when COVID crashed. They are advised by a guy of great pedigree, Nassim Taleb, author of The Black Swan, who basically puts out the idea that if you bet on very rare events, things that people don't expect to happen, they're going to be underpriced. And so naturally, the reward to risk is going to be superior. You can throw a small amount of risk on these far out of the money puts and then get a massive gain all at once. And that's exactly what this Universa fund, Universa Investments did. There's another article, if you look, you can do a little bit more reading on the manager of the fund. And he's a trader just like any of us. But his strategy with this fund was to buy far out of the money puts on index funds, just like the SPY or other more specific funds. And he admits that 95% of the time they lost money. These puts expired worthless, just like the puts you may buy from a week to week basis expire worthless. But he was okay with that because one event, one single crash, just like the COVID crash, and actually he made money back in 2008. So there's only two times in the last 20 years that this fund has made money, but that was all that he needed to have that huge return that actually makes them profitable. So the point with this is, if you are going to be doing this strategy, and it has to be a strategy, it can't just be, I feel like it this Monday, I feel like the market's going to go down. No, you have to be consistent. If you're going to take a put today at an all-time high of the SPY, you have to be willing to take another put on the same day of the week next week, win or lose. You have to. You have to play the statistics. You can't get caught up in your subjective interpretation of price action. Well, you can use technical analysis, but you have to remember that you're playing the long game, the strategy here. You can't just go on your gut. You have to say, this is my strategy for this year, for this 5 years. You have to be consistent in applying this, and you will get rewarded. Just not this week, not next week, not 95% of the time, depending on how far out of the money that you go. So that's my message to people that are doing these put buyings. Don't get discouraged. It will be very discouraging. You're going to lose more than you're going to win. But if you're going to treat this like a business, if you're going to treat this like a hedge fund, then you need to make sure that you're doing it like they would do it, as a broader strategy where they don't care about the losses. They're in it for the long haul. To kind of put a bow on my illustration here, let's do a comparison here of options pricings versus the VIX. And so if on the top here we have the VIX and here we have the SPY, notice how when the market comes down, the VIX goes up. They are inversely correlated. And that's what's always happened most of the time. It's when the market goes off, fear kicks in, there's more movement because downside movements are quicker, and so volatility increases. And so whenever the market starts going down, remember, if you go back to that sheet that we looked at, the data I put together, the highest price for options was actually towards the beginning of the year, and then there was another very high priced option on the beginning of February, and that's because the VIX was very high because it had already gone down. So even though the market's going down, you think it's bearish, you think it's going down, the options are already overpriced. That's not the time to do it. Meanwhile, when we got to the last all-time high on the 16th of February, you can see here that the VIX options prices were very cheap. So as we come up here to new all-time highs, again, the VIX is getting cheaper and cheaper. In other words, option prices are getting cheaper and cheaper. And what that actually does is that makes these puts that you're buying here at the all-time highs cheaper. But that doesn't mean there are higher probability of success. It's a advantageous reward to risk situation, trying to bet on the market going down, but you're just not going to be right that often in a bull market. But because you got them so cheap, you actually are able to make a big return on them if you're consistent. So think about this when you're taking your puts. Remember, you're playing the long game. Remove the emotion from it and just apply consistently and trade wisely. We'll see you guys in the next video.